you're an executive, an early employee, or just a really lucky investor, you might be facing a very good problem to have, and that's a massive, highly appreciated individual stock gain. Let's say you have $1 million of a stock with about a $50,000 cost basis. If you wanted to sell that investment to diversify your portfolio, you can easily wipe out a quarter of the gains just through taxes. And in that case, essentially the tax tail is really wagging the investment dog. And so how can you diversify, lower your risk without recognizing a capital gain? And the answer lies in a highly specialized structure called an exchange fund that uses a section of the IRS code, section 721. So an exchange fund isn't your typical mutual fund or ETF that you're probably familiar with. An exchange fund is an investment partnership that's built or customized for high net worth individuals to diversify their portfolio without recognizing that taxable event. So instead of selling your stock, what you do is you exchange your shares in that investment for interest in a partnership, and that's contributed in kind. And now other investors also contribute their highly appreciated stock into the partnership, which builds a diversified pool of investments. And it's typically meant to align with either like the S&P 500, the NASDAQ, or various other indices to try to mimic the returns of that type of index. So it's a little bit easier to plan and to diversify that portfolio over hundreds or even thousands of stocks. And here's where the tax magic happens. The entire strategy is built around a section of the IRS code called section 721A, which is the partnership rules, where it states that no gain or loss shall be recognized if property is transferred to a partnership in exchange for interest in that partnership. Think of it this way. The IRS views this not as a sale, but a mere change of form of ownership. And you haven't cashed out at all either. And there's a key component here called the carryover basis. Now the original cost basis of your stock, remember that $50,000 that we mentioned, that's going to be maintained as the cost of your share of the interest of that partnership. And that carries over to that new fund. So the gain isn't eliminated, it's just deferred. And that means that the growth or the appreciation of that diversified pool will remain tax deferred. And that gives us a massive advantage of tax deferred compounding. However, if it was just that easy to form a partnership, why doesn't everybody do it? Why doesn't everybody just grab a couple friends and start to pool their investments together to build out a diversified portfolio and partnership all together? Well, the reason is the IRS thought of this as a possibility. And so they have a different part of the section called section 721B, which is called the investment company exception. And it states that tax deferral in exchange for that partnership cannot occur if the primary purpose is the diversification of liquid or marketable assets. So how does this fund navigate the trickiness of this rule? And it does this through what's called the 80-20 exception, in which at least 20% of the partnership must maintain what's called qualified assets. And typically that means illiquid assets such as real estate or commodities or oil and gas partnerships. And when the fund includes 20% of those illiquid assets, the fund structurally breaks the IRS's definition of an investment company and avoids that key caveat. Now there's one more non-negotiable rule around maintaining and staying within the guidelines that the IRS provided, and that is what's called the 7-year lockup period. The IRS does not want people to avoid or create that diversification for short-term interests. You do have to be a long-term investor. And so during this 7-year lockup period, you will gain the appreciation of this partnership during that 7-year period. But after that 7-year period, then you can exchange out or take back out a diversified basket of this exchange fund. So for example, if I were to contribute stock number A with, again, $1 million with $50,000 cost basis, after 7 years, let's say we're lucky enough to grow to $2 million. At the end of that 7-year term, then you can do is basically request a basket of diversified stocks back for your share of the partnership interest. So it might be 10, 20, potentially more individual stocks that you will receive worth that $2 million. That's your interest in the partnership. But they maintain that original cost basis of $50,000. And with that diversified stock portfolio, then you can start to consider things like direct indexing or maybe tailoring or peeling back some of the positions in a more diversified manner. Now, it is critical to reiterate that the Section 721 is a deferral mechanism. It's not meant to eliminate the taxes. We're really just deferring those taxes and maintaining that diversification over that 7-year period without recognizing that taxable event. Now, you don't pay taxes again when you contribute those shares, and you don't pay taxes when you request that basket of other shares of other stocks from those other investors, but you would trigger a taxable event if you started selling that basket of individual stocks. But again, maintaining that diversification is especially important if you've had some very nice gains and you want to try to protect that through that diversification strategy. So the other thing to consider at the end of that 7-year period is what's called a step up in basis. And we have another video on that you can take a look at. But if by the time you get that basket of individual stocks, diversified basket of individual stocks at the end of the 7-year period, you can do is kind of slowly wind it down as needed because you have that diversification. Or one thing to consider is what's called a step up in cost basis, meaning that if we maintain this diversified portfolio and we're looking to leave that legacy to our children or grandchildren or other family members, we can structure it in a way that when you pass away, those assets get what's called a step up in cost basis, which allows the beneficiaries to receive the stock. Again, I'm just going to make that up in the $2 million range. Now that step up goes from $50,000 to $2 million, and then they can sell it at a tax-free basis, potentially. So if you have a concentrated, low-basis stock position and you want to gain that diversification without recognizing taxes, feel free to give us a call. Happy to chat through and share more details about this strategy as well as others. Thank you for taking some time and hope you enjoyed listening to us. If you did, please like, subscribe, and hit that notification bell.